In this video, we're going to look at remortgaging your home to consolidate unsecured and secured borrowing. With the cost of living on the rise, it's never been more important to get your finances into order. If you've got available equity within your home, you may be able to use some of that to clear some of your borrowing. So for example, if you've got a house that's valued at £100,000 and you've only got a mortgage of £50,000, that means you've got £50,000 equity within your property. You can potentially use part of that £50,000 to clear off borrowing. You can then use that borrowing to clear off a number of things. Things such as a personal loan. It may be that you've got a credit card. It could be that you've got a secured loan. It may be that you've got some car finance. It could be also that you've got adverse credit. That could be something like an IVA. You can even use this to clear off historic adverse debt. That could be a default, CCJ, or even an IVA. You can even borrow money potentially to clear a tax bill, which is also classed as a debt.
The reason why debt consolidation could appeal to a consumer is because it will reduce the interest payable across all your borrowings, as you'll be on one fixed payment rather than paying interest across a number of borrowings. Most mortgages have a lower interest rate than unsecured borrowing. That's because the lender has a charge over the property, so failure to pay your mortgage means that the lender can repossess the property and take back the keys. As the mortgage interest rate is lower and you can spread the borrowing over a longer term, you potentially save yourself hundreds, if not thousands per month, depending on the level of borrowing that you have. You have to consider each debt in isolation. For example, it wouldn't make sense to consolidate a debt at 0% into the mortgage. You don't necessarily need to clear all of your debts when you're looking at debt consolidation.
Another really important thing to consider when you're consolidating debt is whilst the monthly payments are lower, the debt is normally spread over a longer term. Now, when you spread borrowing over a longer term, that may mean that you pay back more interest in the end. You also need to be comfortable adding that borrowing onto your mortgage. As Gindi mentioned earlier, when you add borrowing to your mortgage, that then becomes secured. So your property is potentially at risk of being repossessed if you don't keep up with the repayments. With some lenders, when you're borrowing extra to consolidate debt, you can actually have your mortgage over two different parts. So what you may decide is your current mortgage balance is you may want to keep over the same term as your current mortgage. However, when you look at the additional borrowing, you may want to take that over a different term to your mortgage. So for example, you may have your mortgage over 25 years, and when you take the additional borrowing, you may only want to take that over 10 years. That is something that is potentially available to you.
If you've got historic adverse credit, it's still possible to consolidate your debt into your mortgage. If you have historic county court judgments, defaults, a potential bankruptcy, debt management plan, or an RVA, there are lenders available that may consider lending to you. You may pay a slightly higher rate of interest, but it's making sure you approach the right lender. When you consolidate debt, it's important that you don't build that debt up again. Our advice will be, once that debt's been cleared, close that credit card down so you don't have the temptation of building that credit back up.
When you're looking at consolidating debt onto your mortgage, it's really important that you use a mortgage broker. Most mortgage brokers have access to a comprehensive range of lenders, and as criteria is so different with lenders when it comes to debt consolidation, it's important that we approach the right lender. So let me give you an example. So some lenders, when you're looking at debt consolidation, will allow your mortgage up to 90% of the value of your property, whereas some other lenders may only allow up to 75% of the value of the property. So that can make a real big difference in terms of the amount of borrowing that you can take out of the property. Also, other lenders may only allow you to take a certain amount out to consolidate debt. So to give you an example, some lenders will max that up to £50,000, whereas other lenders may allow you to lend more. There are also some requirements with some lenders around debt to income. So for example, if you're earning £50,000 per year and you owe more than £50,000 per year, that means you've got over 100% debt to income ratio. Some lenders will only allow a certain percentage. So again, choosing the right lender is so important when it comes to this type of borrowing.
This type of mortgage isn't suitable for everyone. It's important that you seek the right advice from the right qualified mortgage broker. If you found this video helpful, please check out our other videos around getting a mortgage with bad credit.